Welcome to the Explainer. All right, let's just get right into it. Imagine being able to scale your trading capital up to $1 million, or honestly even more, without risking a single dime of your own personal funds. Sounds like an absolute dream, right? Well, today we're breaking down the exact roadmap to make that a reality using funded Forex accounts. We're going to cover everything from your very first discovery of these zero-fee opportunities all the way up to mastering the daily execution you actually need to keep them. So let's get started.
Here's our roadmap for today. We'll start with number 1, the zero-fee evolution. Then we'll navigate the evaluation process. Third, we'll break down the digital setup and brokers, and we'll wrap the whole thing up with strategies for funded success.
Okay, starting off with Section 1, the zero-fee evolution and the shift in fintech funding. You know, there's a pretty famous saying in retail trading: the search for a funded account free of charge is the holy grail for many retail participants. And for years, that was so true. Traditional proprietary firms used to demand massive upfront commitment fees just to cover their operational costs. It was a massive barrier to entry for everyday people. But the fintech sector has innovated way past those old models. Today, this so-called holy grail is basically becoming the new standard. That initial cost, it can now be completely bypassed or fully refunded. And that fundamentally changes how retail traders can actually enter the market.
So what does this modern landscape actually look like in practice? Well, it starts with performance-based entry, meaning your qualification is determined entirely by your skill, not the size of your wallet. Add to that refundable fees, where a lot of modern firms will actually return your upfront costs right when you get your first successful payout. But the real game changer here? No time limits. Taking away those high-pressure 30-day evaluation cycles completely shifts the focus back to what actually matters: your discipline and your long-term consistency.
When you open one of these funded accounts today, you're essentially entering a true corporate partnership. Think of it as a perfect balance, really. The firm provides the heavy financial backing and the liquidity, while you, on the other hand, provide the winning strategy. It elevates the whole relationship from just a simple transactional customer-broker dynamic into a real shared professional endeavor. You bring the skill to the table, and they bring the capital. Moving on to Section 2, navigating the evaluation process. Proving your skill.
Okay, time for a little bit of a reality check. Because obviously, before they hand over the capital, you have to prove yourself. The evaluation process is typically a two-phase test. It's designed specifically to filter for risk management and consistency. These high-tier firms want to see that you truly understand fundamental dynamics, correlation, and market volatility. Basically, having a great strategy on a random Tuesday just isn't going to cut it. You absolutely need a systematic plan to pass this strict filter.
And here is the magic number to keep in mind: 8 to 10%. That's the typical profit target traders have to hit during the evaluation phase to prove their worth. But, and there's always a but, right? Here's the catch. You have to hit this target while strictly staying within a maximum drawdown limit. It's literally a tightrope walk. It proves to the firm that you can generate solid returns without exposing their liquidity to wild, unacceptable risks.
So how do we build all of this into a clear roadmap? Well, it comes down to a 4-step professional setup. Step 1 is selection. This means choosing a trusted, regulated provider that complies with international standards. Step 2 is verification, which just means completely filling out your KYC or Know Your Customer compliance. Step 3 is the test, where you actually prove your skill on the evaluation or demo account. And finally, Step 4 is the ultimate goal: scaling. Once you're funded and you maintain that consistency, firms will often increase your capital allocation all the way up to $1 million or even more. It's a highly structured path right to the very top.
All right, Section 3, Digital Setup and Brokers, the onboarding roadmap.
So how do we actually get the ball rolling here? First things first, you've got to visit the official website of a regulated entity just to ensure your data stays fully secure. Second, and I cannot stress this enough, submit precise KYC details. I'm talking your exact legal name, your residence, your email. Why? Because giving perfectly accurate data right here is absolutely crucial. It prevents immensely frustrating bottlenecks later on when you go to withdraw your money. Do not skip the fine print. Step 3 is selecting your strategic account type, and Step 4 is locking the whole shebang down with two-factor authentication, keeping your sensitive financial info super safe inside the broker's encrypted systems.
Now, when you're selecting your exact account type, you really have to be highly strategic. For instance, you might opt for a micro account if you're managing smaller deposits and really just want to practice your positional discipline without, crazy high stakes. On the flip side, an ECN account gives you direct market access, and that's designed for high-frequency execution and extremely tight spreads. You have to align the account type with your specific trading style. A scalper's needs are just vastly different from a positional trader holding lower leverage trades.
Selecting the right partner is absolutely critical, and honestly, your underlying strategy should completely dictate your choice. For example, if minimizing your costs is the top priority, a broker like Fusion Markets boasts extremely low commissions. Or maybe speed is your game? In that case, IC Markets offers ultra-low ECN spreads. Need rapid liquidity? XNest provides instant withdrawals. Platforms like RoboForex, FX Pro, and AvaTrade each offer their own unique edges too, whether that's fixed spreads or institutional pricing. The key takeaway? Match the broker's key feature directly to your personal edge.
And that brings us to our final section, Section 4, Strategies for Funded Success. Maintaining the edge.
Okay, let's talk about survival for a second. Because once you actually get the funded account, a lot of retail traders make this really fatal error. They start treating it like a gamble. And that just leads to a massive, rapid downfall. The golden rule to prevent that is super strict, and it's this: 0.5 to 1%. That is the absolute maximum percentage of your total equity you should ever risk on a single trade. No exceptions. If you want to sustain your funded position and actually reap the rewards over time, you have to protect your total equity at all costs. Maintaining that edge requires some really strict daily habits. We already mentioned strict risk control, but you also need daily monitoring, meaning actively tracking your drawdown in your equity curves, using your dashboards. Add in continuous education, because, let's face it, market dynamics shift daily, so staying updated on economic news is completely non-negotiable. And finally, cultivate a professional mindset. Treat this account exactly like a corporate investment. Remember, the market doesn't reward luck. It strictly rewards knowledge, patience, and incredibly robust risk management. Which leaves us with one final really critical question to ponder today. Are you ready to trade consistently and actually transform your market strategy into a funded corporate partnership? You've got the roadmap, you know the high hurdles of the evaluation process, and you understand the strict daily discipline it takes to scale that capital. The tools and the zero-fee opportunities, they're out there, just waiting for those who refuse to leave their success up to chance. Thanks so much for joining me on this explainer. Now, it's time for you to refine your edge and take that very next step.